Welcome everyone to the Kindle Report. Well, we just heard from the president a few hours ago that they're going to extend this quarantine strategy until the end of April. I have to say this is incredibly devastating. It's hard to believe that this decision's been made. As I suggested last week, the medical folks are running the country right now. And maybe it's appropriate. And we're seeing bigger numbers start to expand, and it's hard to tell where this thing goes. I know over the past several weeks I've been a skeptic, but they're starting to see some accelerations, and hopefully in the next 2 weeks the models will start to flatten out. One of the unintended consequences appears that we've entered into involuntary socialism. I remember seeing in the State of the Union that President Trump said that we would never be a socialist country. Well, I hate to say it, we are a socialist country right now. The government is literally taking over everything. My concerns are that once they get in, they don't get out. Over the years, I've joked, if you let the U.S. put an air base in your country, they will never leave. Once we get in, we never leave. My concerns is once the government gets implemented in so many areas of the economy, they're going to stay there. It's very unfortunate what's happened and the decisions that have been made. As I have discussed many times in the past, I believe these are very bad decisions. I'm one of those that think we should have just shut down for a while and then just crank the economy back. The consequences are going to be catastrophic, and I'm not sure what America is going to look like after this. Being a capitalist like I have been for all my life and believe in the capitalist system, we are seeing the potential of a major economic failure because of this. Earlier today, I released a video, and there'll be more videos on it, talking about the banking crisis that's going to emerge again. I've discussed in the past about the dislocation of capital that's occurring. We've seen a spike in non-performing loans already start to happen. We've seen commercial paper blow up. We've seen the Fed try to plug holes. They're not done yet. I mentioned the other day about the Fed's alphabet soup. This is going to continue. I'm not sure where it all ends, but the interesting part is it appears that market participants right now are not as freaked out as you would think. I'll go through detail, but one of our aggressive models is going back in 100% long. Now this particular model I will show you shortly is only down 3.7% on the year, but it is going all back in, and it's all ETFs. But it could be a very short signal. It could last 3 days, 5 days. It could emerge into an intermediate and go much further. In the aftermath, America will emerge as a new country. This makes me very sad to report this, but it looks like there's no way around the socialist environment and then a multi-decade unwinding of the government's involvement. It's interesting as we get ready to go through the technical section of the show, we are seeing a lot of stability in the markets. Let's take a look at the technicals and unpack what's going on market by market. Before digging into the technical details, this is something we haven't talked about for a while, which is fundamentals. And there's a fair amount of information coming out. It's the first week of the month, so we have employment situation coming out. We're expecting, I think, about 150,000 new jobs. Also, we have ADP, PMI manufacturing, ISM manufacturing. Jobless claims is going to be huge. We saw a 3 million increase last week. We're likely to see at least that or more. But as I mentioned in my opening comments, it appears that we're continuing to see stability as the markets are looking beyond everything that's happening at the moment. As I've talked about before, I think there will be other waves and concerns that come up, but for the moment, we're seeing the stability and maybe the markets will be able to take a look at these fundamentals that come out this week. Everything we're looking at, however, is going to change drastically over the next couple months, and it's going to be nearly impossible to determine what is likely to happen as we go forward. In the opening comments, I talked about this strategy that is going full long, and this is the WaveTech multivariant model. Now, this is a model that I'm utilizing from TradeStation, which you're used to seeing on the show, and I'm running dynamic optimized models. The trades are actually updated by myself, and anybody that has Portfolio Expert and goes to the Premier Portfolios can see this. So WTMV, the performance on this has just been astronomical, and it's been in cash, and the current downside is 3.59%. So if you look at it this way, even though it's taking this aggressive buy here, it's so far ahead of where the markets are. Markets are still down 20 plus. What we're seeing here is taking some risks to reposition. If there is some stability comes in and the market sets up and there is some kind of V-bottom and the whole socialist idea seems to play out that everything's going to be okay, then markets are what they are. As you always know, I am data driven. This is basically, if you look down here below, you'll see that the models are going in approximately about 20% per. So it's 100% long when it's all done, minus about 1.5%, 2% cash. So I'll talk about this. If you are a Portfolio Expert user, you can see this strategy. If you're not, find out how you can get on a trial. I'll go through some of the details on the daily S&P, and I've talked about this 5 to 8 day pattern that should unfold. It now looks like it is likely to extend even further. The futures came in 2% lower at the open today on Sunday, and now we are actually up by 0.39. I don't know how it will look in the morning, but it appears that we're seeing some nice bounces off some of the support numbers that are out there. The pattern that's likely to emerge should be a pattern sets up an ABC type pattern. We could see as high as 2850, and I've talked about this before. These moving averages will come into play. We should see a sell-off after this particular move up, but it's impossible with the volatility that we're seeing to determine how much of a retracement until we see exactly what unfolds here. The key is going to be the high that was formed last week, which is 2637. We break above that level, there should be an easy move to 2750 to 2825. Looking at the intermediate here, you can see that there is a potential to go to 2730 to 2829, to get more exact than what I just said, with the extreme right now being at 2918, and this is for this week. A number of things will come into play here. We still have heavy downside action in PPM 1, 2, and 3. The current 10-week moving average is at 3005, and it is declining by 80 points per week. That will put it very close to 2920, which is the number I just mentioned. I would definitely prepare for yet another wild week, but I think the upside will be where this thing plays out. And ultimately, this pattern is likely to unfold in a 4 to 6 week, possibly as many as 12 weeks. That's 3 months from now. That is going to be very bullish longer term. I've talked about a lot of elements that could happen on a downside over the past several weeks. But once again, these charts are telling us a little bit different story, and it's going to take those 2 to 3 months to find out exactly where it's likely to lead us. We did see some net buying in our system, even on the intermediate this week. So there is some nibbling going on in the database. It did get down to 6%. which is as extreme as it gets. That suggests in itself that we're likely to see some stability before we start to figure out whether there's going to be another leg down or not. From the intermediate modeling standpoint, it's going to be several more weeks before we even get close to giving intermediate buys. So these short-term buys will start to rotate in. Over the next couple of days, I'll be discussing those in the nightly broadcast. Taking a look at the 10-year Treasury notes on an intermediate basis, it does appear there's some downside, possibly going back to 0.5%. This will be an interesting chart to watch as we're seeing downward acceleration across the board on the weekly. So after that spike all the way up to the 130 level, we've come back towards support, and we should see a stability and a flag setup down here that ultimately will be a bottom in yields. A lot of folks are talking if crude goes under 20, it's going to crush the market. I do not believe that's the case. We're seeing the May contract trade down to 19.92 tonight, currently trading at 20.54. There's not a lot to consider here from a standpoint of stability because there isn't any. All the PPMs are down enormous numbers. I talked about this the other night, but we could see $17 as low as $14 on crude oil. Last market I'll look at is the gold market. As I've been discussing, gold has been in a crazy configuration. The intermediate chart continues to unfold in that wedge formation that I talked about, is likely to drop back toward the $1,600 level again. The momentum is failing, not likely to be pushing through to new highs like a lot of folks are expecting. Many people are talking about shortages at dealers and those type of things. This is not a real issue with the market, with the futures markets. You can see this flag setting up. It easily moved back to 1,600, possibly as low as 1,580 before we're ready to move any higher. Now the momentum on a short-term basis is very strong, but even with the strong momentum on a short-term basis, there still is a probability for it to come back to test support. This will be the end of the broadcast. Thanks for watching. I'll talk to you tomorrow night.